I watched this movie, Suburbia, last
Okay,
night.
I've never seen it.
1996, directed by, what's the dude's name?
Is it like a psychological?
No. Richard Linklater.
Oh yeah, he's like a famous guy.
Yeah, I've seen some of his works. I've never seen this movie. It's very Clerks-ish.
Yeah,
It's
he does like more cult classic-y kind of things.
Yeah, it's a one-night hang with some. I don't know. It's very nostalgic.
Oh yeah?
Yeah.
It's like the one night to live party in the suburbs.
It's more of like one night to express all your angst and, you know.
It's like the opposite of
Yeah,
Dazed and Confused.
it's
They're all
not-
living their best life
Dazed
for
and
one
Confused
night.
is a good hang.
Yeah.
This is a nostalgic hang, but I don't know if I'd necessarily call it good.
Yeah.
You might feel angry at the end or unresolved or just, just a little upset.
All right. Yeah, I'm not going to watch that
So,
one.
yeah, don't watch it. I was going in for a good vibe.
I like a nice good
because
hang.
I thought it was going to be like a Clerks vibe.
Yeah.
It's a good vibe, but yeah, it wasn't. Anyway,
Speaking of not a good hang.
speaking of not a good hang,
is,
so
investing money in a company and then it gets sold and you don't get anything.
and then piecing out. Yeah. So last week, Charles alerted me to the Philz Coffee sale, which doesn't seem like it's fully gone through yet. I saw some articles saying that it went
Maybe
through.
August 8th was a date.
That's what it
in one of these
said, but then I
articles.
thought there would be another
I know, it always
article
takes
saying
time.
we're dialed in.
Yeah.
So Philz Coffee was, I mean, how do you say it? Is it sold to or invested in by
It's like
a private equity
officially
firm?
sold to.
Sold to.
It's like private or venture cap, private equity investors.
$145 million.
Is the headline, but
Oh, okay. Keep
right.
going.
I mean, that's the headline.
yeah.
But with any situation where like the founders of a company take money over time, right, at certain valuations, it becomes what those investors are owed, that it's not necessarily that anyone pocketed
$145 million. So I pulled up a little track history. Again, this is all half-assed internet research, so we'll see how accurate this is. But I got a little statement of Philz Coffee's funding rounds. And the ones that I saw readily available to the public are May 15th, 2013, $8 million of a Series A round. February 15th, 2015, $15 million. And then in September 13th, 2016, $45 million. So $75 million prior to this one. And that feels like at least.
At least, because you never know if there is anything before the Series A. There could have been. So it's at least that much. And the interesting thing as well is you can there are a few articles that talked about the valuation, which is really important when a company's raising money, especially from like a venture capital point of view. So this says like their Series C round valued them around 280, and then the C1 round, which this says there was a round in 2020,
Okay.
put them at like a $300 million valuation.
And that would be a valuation on the company if there weren't these debts from these previous rounds or people owed money? Because
yeah, I mean,
how does it shake out?
We can back up and I can put on my finance Wall Street hat and just talk a little bit about when you start stacking private equity or venture cap raises on top of each other, the new investors there's gonna be continual asks. And anytime that you're raising, right, it's like you start to get into what is every company, whether it's us as a smaller private company to a Philz or somebody that goes public, right, or a Blue Bottle, or somebody with a really complicated capitalization table that essentially describes the debt you have, the equity you have. So in this case, it's and again, you don't know here if they had debt as well, right? It's you're not going to know that without looking on their balance sheet, but they had any kind of debt and then equity, and there's different priorities of that equity. And so the first time they raise money, usually those investors are coming in with some kind of preferred equity. They're not buying common equity. You hear you hear about unfortunately, the employees who bought money, they bought common equity.
Right. This is a question I had. So in all of the articles, it said there's about 10 employees who bought common stock, and some of them up to like $10,000 they spent on this common stock. And in the sale, all of that common stock is going to be dissolved. Like none of the employees that invested in that are going to get a payout at all.
Yeah.
So one of the questions I had, what is the difference between common stock and privileged stock? How do these work? Preferred stock.
Yeah, preferred stock. Is
privileged another word for that? I saw that pop up, or is that just a mistype on someone else's article?
Yeah, I mean, maybe it's colloquially privileged in that it has higher rights, but usually, technically, it would be called like preferred stock.
Okay,
and it's higher. So talking about like a cap table or a capitalization table that ranks like who's entitled to like the first amount of cash that's available.
Who eats first?
Yeah, who eats first, right? And within any company, it's usually like if someone has a debt claim, right? Like we can back it up to like if we have a bank loan and something happens to us,
the bank needs to eat.
Whether it's a sale or a bankruptcy, the bank eats first.
Right.
Right. That highest level of debt, that secured level of debt eats first. And then after you work your way through different levels of debt, then there's different levels of equity, and that preferred equity is going to eat first.
Mm-hmm.
So when companies are raising, venture cap or private equity, those shares are going to be some kind of preferred shares where those investors get to eat first. And so you look through, especially when there's multiple rounds, it's like, it's cool. They've got the first people that came in and have made an investment, and there's going to be terms on that investment, like in terms of priority and in terms of there's often, we think of like equity in terms of you get out what you put in. Like if you're in the stock market, right? You're buying one share and selling, you buy one share of something you like. Buying Google in the stock market, and I sell my own one share, and then I sell my one share for whatever it's worth.
And you get that money back. But if you're investing in a company, you put in the investment, but it's just debt that sits on your books, right? Is that
for these private equity companies that put in? There's often these things called liquidation preferences that are in the investment agreements as well that guarantee them some multiple of their investment.
Got it.
So, these people that put in money, it's not just that they put in a certain amount of money. It's kind of as a company, when you take that investment from that venture cap or from that private equity, and there's a liquidation preference in there, it's like you're often like guaranteeing them, or they have the right to eat that certain amount of like 2x what their investment is, or 1.5 or 2 times.
Got it. So let's say you invest in the stock market, and there's no guarantees in the stock market. You could put your money into whatever, and the market kind of dictates how much money you're getting for that. Right. If it's a good year, the company's doing good, you might get more or less or whatever. It is what it is. But then in the situation that you're describing, if I'm investing and I have this guarantee that's like, I need 2x, and that 2x isn't met, then when new rounds of funding come in, the first thing they need to do is backfill whatever that differential is.
They're taking it then, or they're just staking that claim for the future. And that's where you can get into a situation where there's nothing left for common shareholders in a sale. That seems like, hey, $145 million. That sounds like a ton of money. Well, it sounds like it, but if you go back and look at what each of these like preferred investors or preferred investment agreements have in it, it's like, cool, there may have been $75 to $100 million of money raised, but when you start looking at like the multiples essentially that people are due, right? It's like,
because if all those were 2x, you're at 145 already. Yeah. So there is a situation where it's like, cool, we got 145. We raise 145, and it basically nets us to zero.
Yeah, right? for the common,
for the normal people, the common stockholders, because
of this liquidation preference will it's kind of often some of the protection that the private equity or venture cap people are building in.
And then what are the legalities around that? Do you know if I gave someone 10 grand, I'm like, cool, I bought 10 grand of common stock, is it protected in any way?
It's usually not in the way that again, it always depends how the agreement is written, but there's an article I think there's an article in here where they actually interview the CEO who was put in place by the private equity, and he says like that's not they asked about the common stock losing all their money, and he's like, that's not an easy thing. I'd say with any investment there's risk, but no, it's a bummer. They says there's no current team members will impacted. Well, all those people who invested were at some time current team members, so it's like that's kind of a
they
bummer.
Don't work here anymore, so we're good.
Yeah, that's kind of a that's like that's
it's just not a great.
It's a rough look by the CEO.
What article is that?
There's an article, KQED.
Okay, I saw that one pop up.
He says, and as we think about moving forward in our growth, it's something I don't take lightly. Yeah, I mean, those are just like
fluffy words.
Yeah, those are just words you can say when you're like trying to deflect something.
This was not the CEO that was there prior to the buyout. Is that correct?
Yeah, he was there prior to the buyout, but he was right. And I mean, again, this is a good place to step back and again say, as you start to take venture cap and private equity money, a board is formed. Right? It's like, hey, we have a board, and it's me, you, and Jared.
Yeah.
We get to decide the really important things that happen with our company. But as companies take private equity or venture cap, it's like there's going to be a board that is formed, and all those investors are going to have their own people on the board.
Right.
So likely by the time... I would imagine that Philz had a board that is made up of a majority of their investors. And those are the people who are controlling the company and making the decisions. And they're the ones who put the CEO in place. Right. The board and it's like, as you raise more money, you bring on more board investors, which kind of hand control of the decision making over to your group of investors and not maybe necessarily from the founders anymore.
Phil himself.
I mean, his son took over
Jacob.
In the early mid-aughts?
Oh, it looks like I guess maybe they co-founded it together. He founded it with his son.
I mean, it's a really awesome story in the beginning, right? That like Phil, as a Palestinian immigrant, grew up in the Bay Area, started selling coffee in 2003 inside a bodega he ran in the Mission.
Yeah.
It's like, it's a cool origin story, and then you can just see over the course of 20 years the arc that different businesses take.
I never realized how deeply ingrained in San Francisco they were, and one of the things that I've actually never been to a Philz.
Yeah, I've been to one, but I didn't order coffee there. I just wanted to go look at it.
If you don't have an espresso machine, it's hard for me to take you seriously. I just can't do it, man. I'm I don't need your weird pour over, but I'm going to go at some point. But when I worked at Ritual in the Mission, because we're on 21st in Valencia, I'd have guests come in and they would say, only two places I'll get coffee in the city is here and Philz. Like, I love you guys and Philz. And I'm just like, what is this? But I didn't realize they were basically in that neighborhood, started only a couple years prior, even though they feel like functionally really different business models, completely different cafe models. They're kind of born out of the same era in the same place, in the same industry, but completely different animals now.
A lot of the articles talk about just, kind of the rubbing shoulders with the tech companies, and that they served drinks at Mark Zuckerberg's wedding in 2012. So, you just see kind of the tech money, and a lot of the venture cap and private equities are obviously invested in similar kind of areas.
So what do you think okay, how am I going to describe what I'm thinking here? You have a concept that people really resonate with. Philz created something that a lot of people resonate with. And it seems like, even though I've never been there, from what people tell me, they do a really good job of, they have this sense of theater, like everything's a pour over, you can customize. They've created this hook for their guests. So you got this thing that people really like. It starts to grow. People invest in that thing, presumably because they believe in what this thing can create. So it's like, Philz is good. They're creating positive change, or they're a positive contribution to the culture. I believe in that, so I want to invest in that to help that thing grow. Then over time, you've got multiple rounds of investment, and the thing becomes further and further away from what it was in the beginning, which seems like it would make it less attractive to investors, but is it more attractive in the sense that a bigger investor can essentially shoulder a large financial burden, and then if someone like Philz is marginally profitable, they're able to grow it over the next, 5, 10, 15, 20 years, even though it may never again have the cultural cachet that it once had, it's still incrementally profitable enough for a company that's got a bunch of big longer term investments. Is that a thing, or am I just making that up?
I mean, that logic makes sense. It's like, I would say for most of these coffee companies, in terms of the investors who are investing into them, it's like if you look at TPG, right? They're the largest investment firm in Philz. The other companies that are the main, like their previous investments are like Airbnb, Uber,
right? I'm seeing like
Spotify,
Summit Partners, or
Zscaler.
Okay.
Like all these companies are companies worth hundreds of millions, billions of dollars. And so it's like sometimes like the coffee side of this is so small, incremental to what these really large investment firms do. And the same with Blue Bottle. Like this is just kind of like a smaller, version of Blue Bottle, to where it's really more, my thoughts would be that these are just more of like brand pieces for these investment firms, because their money is being made in tech. Like,
right. So
anyone who runs anyone that runs a coffee shop knows that you're not making a ton of money running a coffee shop.
Right.
And I think that's ultimately what they ran into here, is just similar things that they kind of ran into with Blue Bottle, is like these investors, maybe they get excited about, they love these coffee shops and stuff like that, and they put the money in, but over time you see how hard a business growing a retail business like a coffee shop is, that it's really hard to grow and scale. And so it's like with Blue Bottle, you saw essentially like all the investors get together, and hey, that was a brilliant deal for the investors to get Nestle to pay $700 million for 45 Blue Bottle stores. And they kind of got together and they found a way for them as investment firms to make money out of it. And, this kind of seems like maybe they're just trying to get some of their money back, because I don't know if any of these investment firms made a ton of money out of this one.
It does make sense as a brand showpiece. It's just one of those cool things that you can tell your friends, oh yeah, Blue Bottle's part of our portfolio, or Philz is part of our portfolio.
Yeah, it seems more of like a brand piece than, again,
cool
when you're investing in Uber and Airbnb and Spotify. It's
right. Philz is just minuscule compared to all of those
tiny
things.
And so that's where it goes back to like, the common shareholders receiving nothing, is that, retail, it's a really hard business. And I'll just say, like, in my experience, it's like when the common shareholders receive nothing in a deal or a bankruptcy, it's usually because there wasn't any money left. And so whereas, Blue Bottle, it seemed like everything was growing and doing well, and they got Nestle to pay this high price for it.
And you can see that in the numbers. I wanted to ask you what you thought about that. So Blue Bottle, $700 million for 40 plus stores. Philz, $145 million for 70 plus stores. So Philz is kind of twice the size. They have a pretty big cultural impact, and the number just seems small compared to Blue Bottle, or Blue Bottle might just be astronomically large.
Yeah, I think Blue Bottle might be an outlier in terms of, you never know the relationships that some of these like really wealthy and influential PE, private equity, venture cap investors have in how they're able to get Nestle to pay that kind of price, kind of banding together and like using the power and the platform that they have. It's like there was something happening there where they were able to get Nestle to that $700 million number.
So there's something about the brand itself, but also probably the relationship that the people who are the stakeholders have with other
100%
high power individuals. Yeah, okay.
Definitely. And then with this one, it's like, for sure, TPG is a huge investment firm. But this was more of the company being sold to the investment firms. It's like they weren't really able to find a strategic buyer to buy Philz. This kind of seems more like a situation where the investors didn't want to put any more money into it. Or, I mean, you could just say the investors didn't want to put any more money into it. And I mean, you could say when you were talking about the numbers relative to Blue Bottle, it's like, it did say like what around in the last round, the Series C in 2016, it's like they valued Philz at 300 million. So, I mean, that's still a huge valuation. And not that it's 700 million, but it's like when you start getting into the hundreds of millions, it's that's still a huge valuation. And to see money raised at that valuation and then to eventually be sold to them for $145 million, it's like that's where I talk about kind of like, what kind of liquidation preference did TPG have when they invested at a $300 million valuation, thinking the company was continue to grow, and that the valuation was going to continue to increase above $300 million, and then for a sale essentially to occur to them at
half of valuation.
That's where there's not going to be any money left for the common shareholders, because Philz, it seemed like from that growth trajectory that they were on in 2015, 2016, 2017 to where they are now, that things didn't turn out as optimistically as maybe those investors had hoped in 15, 17, 16, 17. And it's kind of not to say it's like a bankruptcy where someone goes out of business, but it's like it's investors essentially taking on,
it's like an investor bailout or in some way,
kind
shape,
of like
or form.
Them taking over the company to run it, and see what happens if they're able to maybe find a strategic buyer to try to sell it to. But it seems like a situation where the venture cap and private equity, they're not making the money that they thought they were, so they're kind of cutting out the whatever like liquidation preferences and like whatever claims to cash flow and claims to money the investors had, like, so those were all right. There probably wasn't even enough for all of them, and so the common shareholders are not going to get anything in that situation.
I knew what Phil was getting, or his son was getting, or the CEO was getting.
Well, and they might have got things along the way, right? Because they could have been like selling shareholders in any of the initial rounds of funding.
Right. So here's what I'm thinking. The articles I read said that there were only about 10 employees
10 to 15
who had this common stock. And the one that they quoted specifically was someone had invested $10,000. Yep. So I'm going to assume that that's the max that any one of those people had invested. Because
there's like 10. One of them maybe said 12 or 12,000 or something.
So the total payback for all of those, based on the latest valuation of the company, couldn't be an astronomical amount of money. Is there a way that you could pay those people out? It would be such a tiny amount of money compared to the whole thing, and write it off as a marketing expense, because it's a good story to tell, and it's the right thing to do, to where it's like, hey, the common stock was going to go away, but we decided that these people invested in the brand that we now love because we bought it, and we're gonna honor that stock, and it's going to be just like fractions of a percent of the total sales. No one's going to notice it.
Yeah, 100%.
Right.
That's the disappointment, right? Because it seems like the optics could have been a lot better for these guys.
You make the sale, you spend an extra whatever. It's like not even going to be $1 million. Not even close. And then everyone's just like, dude, Philz is a company who they were going through whatever and they had to sell, but they took care of all the people that helped
them along the way.
They took care of the people that believed in them enough. If you're an
employee, their own money.
Right? If you're an employee and you're going to invest $10,000 in something, and it's you could invest it in the stock market, you invest it in like another company, but you're like, you know what? I like Philz. I love my job. Like, I believe in the future of this company enough to trust you with my money. Come on, man, you got to pay that back.
Even if legally, even if there's no obligation,
for you should pay it back.
Yeah, right. It's like. Yeah, that's the hardest thing for me to believe, is that no one around the table was sitting there being like, hey, this is an opportunity for a great story.
100%.
If we're going to, kind of have this Philz brand, and we understand how tight knit the specialty coffee industry is, and how much people know about what's going on at different companies, and it is about like how well people treat their team members. Like everyone knows how that works at different companies, and this is just such an opportunity for them to do the right thing.
Yep, and that's going to result in you're telling the great story people can tell other people, retention of current guests, accrual of new guests who are just like, oh, this is one time of private equity investment or acquisition went right.
Yeah,
somebody did the right thing.
Yeah.
Nobody really loves to hear these stories of private equity buying these beloved coffee shops, but man, this is the best version of that. That's the opportunity.
Yeah, because as you hear about them, especially in the Bay Area, right? There's Sightglass, who took PE, private equity money, and the founders got forced out, and now it's being run by like a former Starbucks person, and essentially run by the board of directors, which is PE run, right? Private equity run. You got the same with Blue Bottle Sale. Now you've got the Philz Sale. Trying to think who's left. I guess Ritual is left as an independent.
Eileen owns the company.
Yeah,
she's the one.
Yeah,
but yeah, not all. I don't want to say all of, but so many of the big players from that era. Intelligentsia, Stumptown.
Intelligentsia.
It's a tricky one for sure, man. Yeah.
Yeah, but that was just interesting. Definitely like an interesting thing to talk about. And again, I think what I take away from it really is just like it's just a missed opportunity to do right by people by the people who make your company what it is.
Yeah,
right?
I just can't. It's just hard to imagine dishonoring someone who believed that much. I'm struggling with saying, is this like, in the position that I'm in, it's like, it's interesting because you have this business in some ways it's very personal, but in some ways there's a differentiation between like who you are as a person and then what the business does. Right. And it's like, part of me wants to be like, dude, someone just tip them off ahead of time. Like, like somebody nudge them in the shoulder and be like, dump that shit now, bro. It's not gonna be worth anything in about a month. Like, get rid of it. Like,
well, and again, there's likely not a secondary market for those kinds of private investments.
So who does the company have to buy it back? Like, if I had common stock, if I had spent 10 grand and invested in all this common stock, and it's we're a year in the past right now, like rewind before this happens. I'm like, hey, I want to get rid of this stock. Like, is the company obligated to buy that back?
No. That's what you'll see in a lot of common stock agreements. And that's kind of what the CEO here is alluding to, is just there's a really large section in most common stock purchase agreements about all the risks that the buyer is undertaking.
So,
and how there is, while they are voting, there may be voting shares, there is a huge amount of risk, and there is no guarantee as to what you're buying on. A bit when you're buying common stock, you're buying on faith, especially for a private company, right? In the public markets, right? You buy common stock, you kind of have an idea. Hey, if the company goes bankrupt, I'm probably not going to get anything. But there is a really generally liquid market for buying and selling the shares of your common stock, whereas generally with private companies, that is much, much harder. And again, there's a lengthy paragraph a lengthy part of that agreement which will say that there's no guarantees as to what happens with your shares.
So buying common stock is just a terrible idea.
And then private companies is if it's not your business as a venture cap or a private equity investor.
Yeah, as an employee, would you say? It sounds like a terrible idea, because basically what you're doing is you're buying stock, but because it's a private, independently owned company, you're basing your investment off of your belief or the juice that you think the company has, i.e. this could be a big thing. But since there's no guarantees, you're also putting a ton of faith in whoever's at the head of that company 100%. And saying, this person is trustworthy and they're going to honor my investment. So that's why I don't want to make it personal, because I don't want to make assumptions. But I'm just like, who was at the helm when these things were being sold? And it almost seems like whoever that was should make some sort of effort to make it right,
because there could have been, and again, we'll just talk more like theoretical. It's like, just say there's some company where team members are buying common stock of a company, just like company A. There could be a time as company A is taking private equity or venture cap investment where the founders no longer have majority control.
Sure.
Right. So it's like, team members A, B, and C are buying common stock in the beginning or earlier days, and then at some point
the control
switches from the founders to like the private equity or venture cap investors. Right. So it's almost like at that time, right? It's like, again, the founders kind of made the decision that they're passing control over to other people.
Right. So we could use us. None of this is real, so this is just a thought experiment, so we don't have to say anybody else's name. All right, so let's just use us. So let's say like we at Cat and Cloud decide to offer our team members some sort of common stock. Yeah. We're taking people's money, giving them common stock, and then at some point in the next 3, 5, 10 years or whatever, we take on some rounds of investment. And we're still part owners of the company, but we don't have the controlling share. We're minority owners, so we're not the decision makers. We're not the decision makers. Somebody else is. So while people bought those stocks on good faith and the belief in us, we don't actually have the power to make good on the thing anymore.
You would only have the power up until, right? We would have to, at the time that we, like right before we passed control over to the new people.
We're going to cash all these out to make sure that these get honored.
Yeah. Or like, do you believe in the new people? Right. Do you want to believe in the new people and take your risk with them? Or because we are no longer going to be able to do what's right for you. Right.
We're not in the driver's seat anymore. We're figureheads, essentially. Yeah.
So it'd have to be kind of at that point when there was something made to help either take care of people or not. Right. Or at least give those individuals the option of what they wanted to do.
Yeah.
That's where it becomes complicated.
Yeah. I'm not a financial advisor, but buying common stock of an independent company sounds like a terrible idea.
Yeah, but it's like I understand. It's like when you really love a place and you really believe in the people. Yeah. It's like I totally understand.
Because you would feel so proud if you were early on in the company, especially you had some sort of stake, you bought your stock, and then over the next 20 or 30 years, this company becomes a huge cultural institution. You're like, I was here since the beginning. I own a little bit of the company. Like, if it goes well, like you get to have a good living, live a good life, like doing a job that you love. It's like, I've been here for 15 years. Isn't this great? Like, that's a great story. Like, that's cool. And I get why people believe in that shit, Like, pfft.
Yeah, it's just it can go a number of different ways, and they aren't always awesome, I guess, the way that they go.
Sideways, dude.
Yeah. So I don't know. Yeah, I feel like that's what we wanted to kind of talk about a bit this morning.
Yeah. If anybody wants to give us $100 million, I'll honor all of the common stock. Holy crap. I'm wondering there was one more thing that I was really curious about I want to know the details. Each current Philz Coffee employee from barista to C-suite will receive a thank you bonus as part of the deal, which will range in amount depending on employee rank. I'm just curious as to what that is.
I mean, is it $100, $1,000?
That's why I'm curious.
$5,000?
Yeah, I'm really curious. It's probably very low, or else they would make it incredibly public. Because again, it would be a great story to be like, we're giving
everybody's
them thousands.
Giving like $10,000 to $50,000 bonus, depending on the person. But that's just where, again, if there's money for that.
You're not in as Yeah, I get you.
Again, from a story point of view, it just seems like a missed opportunity to do right by
It'll
people.
be cheaper than whatever marketing campaign they're going to run or
totally.
whatever bullshit damage control they're going to have to do.
Hey everyone, that's the podcast for the week. Thanks so much for listening. If you heard something that inspired you, or if you heard something that gave you more questions and answers, send us an email to podcast@catandcloud.com. And if you're looking to know more about us, then head to our website at catandcloud.com, where you can find everything we have to offer. A great place to start would be The Answer, our house coffee that's right for any occasion. Or the Best Friends Blend, a coffee that tastes just as good as the good it does by donating $1 per pound back to our partnering producers. Also, if you're feeling extra friendly, connect with us in the usual places, like YouTube, Instagram, pretty much everywhere that's hip. All right, that's it. Thanks for being awesome, everyone, and we'll be back next week.